how not to use your CBILS and bounce back loan cash, business confidence, and latest CBILS and bounce back loan figures, all in this week's Business Finance Bulletin. Hi, this is Rob Warlow from Business Loan Services, the commercial finance expert, and welcome to the latest Business Finance Bulletin. Now, over the last couple of weeks, I've had some interesting conversations with business owners who are now awash with cash. They've received their CBILS loans, or more particularly, the bounce back loan, and they're thinking about, right, what can I do with this? Now, the conversations have been based around questions. Rob, I'd like to use this cash to pay off my loans and my asset finance facilities. How can I do this? And the first thing that I say is no, stop. The bounce backs and the CBILS loans are not designed for you to go paying off existing bank debt. The whole idea of these schemes, of course, was to provide cash flow to those businesses who were faced with critical business expenses and just didn't have the cash flow to keep the business ticking over until things picked up. The scheme was never designed for you to take that cash and pay off existing debt. Now, I know it's tempting because the conversations I've had, well, I got a loan which is kind of charging me the rates of 10, 12, 15%, and the bounce back loans in particular, the rates are 2.5%. Sure, it makes sense for me to pay off my more expensive debt. Well, in theory, yes, it does. However, there's a bigger thing to play here. You've got to think about what happens if demand in your particular sector doesn't pick up as quickly as you'd hoped. Wind forward 2 or 3 months. Your demand is still low. You've still got all these expenses to pay. You don't want to be looking back and thinking, I wish I hadn't gone and taken 40 grand of my money and paid off that loan. Because the thing about paying off the loans is they're not like an overdraft facility. You pay the loan off and 2 months later you can't go back to your loan provider and say, hey, I paid that loan off a couple of months ago. Do you mind if I have that money back? It's gone, it's lost forever. So please think really carefully before you go paying off existing debt. My advice, sit on the money for 3-4 months just to see how the market pans out. Once you've got a little bit more certainty, then you can make those decisions about using any surplus cash. But for now, sit in it. That old adage of cash is king has never ever been more true. As we know, business confidence has really been shaken to the core over the last couple of months. The latest Lloyds Bank Business Barometer survey has revealed that business confidence, as measured by their index, is down to levels not seen since December 2008. I also looked at a survey undertaken by Aldermore Bank. They've reviewed the kind of income shocks and drops that sectors have taken. The sectors which have suffered the most, perhaps not surprisingly, is hospitality and leisure. Their income has dropped by 54%. In next place was food and drink sector. Their income has dropped by 52%. Looking at all SMEs across all sectors, the average drop in income comes to 34%. So we can see a lot of kind of pain out there in a variety of sectors. Now, what can you do? And I had an interesting conversation with a business owner this week around kind of scenario planning. Now, in this case, he'd had applied for a CBILS loan and already had a cash flow forecast in place as part of his application. Now, you've got a great tool there. Now, if you have applied for a loan and you've got a cash flow forecast in place, now is the time to bring this to life. Get your cash flow forecast and add in for each of the months an actual column and start plotting what you actually spent in that month. It's a great sense check so you can keep on top of your overheads and also you can test how good your planning was. Now, going forward, my suggestion to you would be now taking a cash flow forecast on a 3-month rolling basis. Take a 3-month forecast and just start putting it in play what you think you're going to do. Perhaps have 3 scenarios: worst case, best case, and the likely case. It really will help you keep you focused on that all-important cash position. So really now it's down to managing your overheads and also making sure that you are forecasting ahead so you don't run out of cash. Well, it's close this bulletin with our regular look at how these CBILS and bounce back loan schemes are performing in terms of amount of cash distributed and the number of loans approved. The figures to the 24th of May have been released by UK Finance and HM Treasury, and the figures as always make interesting reading. In total, across all three schemes, that's bounce back, CBILS and the large version of the CBILS, the total amount of disbursed comes to £27 billion. Now that's a staggering amount of money that's been released in a relatively short space of time. So how is this broken down? Well, bounce back loans, that comes to £18.4 billion. CBILS, £8.1 billion, and the large CBILS, £820 million has been distributed. What about the actual number of loans? Well, the number of bounce back loans is 608,000, the CBILS 43,000, and the large CBILS 154 loans. So you can see there's a really good concentration in terms of the bounce back loan scheme, and that kind of reflects the ease with which you can get hold of that loan. What about the approval rate? Well, the bounce back loan approval rate is 79%, the CBILS is 51%, and the large CBILS 31%. So again, we can see the emphasis there on the bounce back loans, which has got a much higher approval rate, primarily because, see, the application is very simple, 7 simple questions. Now, there still seems to be, say, a 20% decline rate, and this is really down to, well, you know, it's mainly some credit checks that firms are doing that shouldn't actually be happening, and also banks are now starting to weed out applications which essentially could be fraudulent. So I don't think we're ever going to see a 100% approval rate there, but 80%, that's pretty good going. And we've got to take our hats off to the banks. They've rolled this out fairly quickly, and yes, there are going to be some firms that are going to be disappointed in terms of process breakdown, but we know the banks are kind of working very hard to close those gaps. So if you haven't yet applied for those schemes, do look at them. There could be the difference between you staying in business and not. Well, that's it for another bulletin. As ever, I hope you enjoyed watching it, and if you did, please don't forget to give it a like and a share. So that's it. Look forward to being with you next time. In the meantime, have a safe, profitable and healthy week.